1 month from today, there will be another forum, which will be held in Boston at MIT. And it's called the MIT World Real Estate Forum. And in this forum, I picked up one panel which is entitled Growth Markets Eastern Europe. And I thought this name Eastern Europe rather than CE or SE is pretty interesting. And the subtitle of the panel is saying the following thing. Newly developing economic regions of Eastern Europe will provide immense opportunity for real estate. Incidentally, the chair of the panel is here with us, and it's Mr. Babis Pandis, the partner of Blue House Capital. So, Babis, we're looking forward for that panel, and we're looking forward for new US capital to come to the region, and in particular, let's say SEE, which is the focus of our speech. So with that said, let me dwell into the slides. Slide number 1 is about trading volumes in the CE region. We picked CE because it's that's the one that is mostly followed, and we have more statistics about it, or it's being more actively promoted. What I would like you to point out on this slide is that for the first time last year, the total trading volumes, investment volumes in the CE region have exceeded or matched really the maximum volume that we had pre-crisis in 2007. I think that's a remarkable achievement, and the difference today compared to 2007 and 2008, I think is there's a lot less leverage in the system, in particular in the SEE markets. I think that the metrics of the market are much more sustainable now, and we are still in growth mode. So hopefully and presumably in 2018 we will see further growth in the region, and definitely in some of the more eastern parts of the CE/SE market. Serbia and Croatia is still a small share of this market, but we are already seeing and hearing about signs in these markets as well that trading volumes are increasing, and some of the recent transactions are quite notable. If you look at this chart, you will see that the EU or CE, EU Consumer Sentiment Index, which is lagged by 18 months, follows very, very nicely the trading volume increase in the CE market. The expectation, the Consumer Sentiment Index is still strong, so expectation is that if it will continue to be correlated, then volumes will continue to increase. This is a crowded slide, but I think it's very interesting. We plotted most of both the Central Eastern Europe and Southern Eastern European capitals in terms of yield evolution. And what you can see here, if I would find the pointer, but anyway, in where the lower section, where you have the more developed markets, you can notice that in 2016 there was a marked compression of yields. Obviously in Warsaw, in Prague, very notably in Budapest, which is continuing to decrease. And the markets who were lagging behind were the SE markets, Bucharest, Sofia, Zagreb, and so on. These are the markets where we feel the potential exists in the current year, in fact, and also in the next year to witness increasing trading volumes and moderately decreasing capital rates. This slide is also very interesting. If you look at the left-hand side, and then the right-hand side of sort of the middle point, which is Bucharest, you will see that in Prague, Budapest, and Warsaw, you already have lower cap rates, lower yields than we used to have in the pre-crisis level. Whereas in Bucharest, Sofia, and the other Southern Eastern European markets, you still have in prime office yields, you still have a gap, a positive gap compared to where we were in 2007. The rationale, we think, behind this is the fact that after the crisis, as you gradually saw more and more investment going into real estate in Europe, investors still preferred to stay in the markets where they were familiar with. So Prague, even until Budapest, these were markets already known to some of the core investors, and they preferred to stay on the safe side. So this is why we witnessed a very strong compression of yields, whereas in Southern Eastern Europe, we're still waiting for that to happen. Just very briefly, we plotted the key metrics of the office markets in the Eastern European markets. The relevant question here would be one relevant question here would be, where would you like to invest as an investor? And obviously, you would like to invest in the markets which are growing, and that's the one data point that it's not on the slide, so you'll have to use your memory. But basically, countries like Warsaw, Budapest, Bucharest, Bratislava, I mean, their respective countries are growing by roughly 4%. Bucharest has grown by 7%. This year is expected to grow by 5%. And the markets which are lagging a little bit is really Serbia and Athens. So wherever you have high growth and relatively low vacancy rates, I think those are good markets to be invested in. And I would definitely highlight Bucharest as being in that position, but also other markets. Even the markets which seem to be quite expensive, like Poland, are with the still strong growth rates, they continue to be appealing for investors. The story is a little bit more nuanced in industrial compared to offices. And if you look carefully at this slide, what stands out in industrial on a relative basis is Serbia, Belgrade. It is actually one of the countries where cap rates, according to our reporting, are lower today than they used to be before the crisis. While in some other markets like Budapest, which is very, very hot on the office sector, yields have not come down so much. We were thinking about why is that happening, and the argument or the explanation we came up with is really the labor force, which is very, very important. If you look at some of the reporting in Hungary today, you have the highest quote-unquote complaint by new investors in terms of industrial investors, in terms of their ability to find labor force. While in places like Serbia, you have a very good geographical location, good infrastructure, and you also have very good availability of labor force. So that's where we're seeing now the industrial real estate investment going very interestingly. In terms of the challenges, we can see across the region a lot of populism at the political level, so that is sort of a challenge, but whenever investors come to Romania, we explain that it's okay, I think. It really is. I mean, it's more like a soundbite for us. The end of very low policy rates in the credit markets, yes, this could have an effect on generally on financial markets, and we will have to see whether that will impact. It will surely impact real estate. The question is, will it stop the yield compression? And there's arguments to say that in these markets, including Romania, where we didn't really see a lot of compression, but we are still seeing an increase of capital going into the sector, it will actually not revert the direction of yields. Geopolitical risks are obviously global. Russia, United States nowadays, and well, the Korean Peninsula started to become more friendly. And it's a very heterogeneous region. So we're trying to force these countries into this CE, SCE, even Eastern European category. But what we are seeing is that, and I think everybody else in the room, investors are very much opportunistic based or knowledge based. If they know Warsaw or Hungary, then that's where they are first looking. Yes, the regions hold, but only to a limited extent in terms of classification. If I can just mention a few words about Romania, it was the largest, strongest growing country in Europe with a GDP growth of 7%. It is very strong in terms of the growth of the IT sector. My colleagues are advising me that the growth was, I think we were number 3 after France and Poland. So we are very competitive in that market. If you look at the, may I call it arbitrage, the spread between where our government bonds are compared to other markets and then where our real estate yields are to other markets, there's a very big gap and arguably an arbitrage opportunity to come. Of course, there's explanation in the liquidity side of the market why that spread there is, but where there is that spread, but I think it's a great opportunity. Real estate assets continue to have very attractive yields. This chart really says that, you know, everything in the market, you know, doesn't happen like that. We report like that, but it happens exponentially. See Hungary, see what happened in Hungary in the last year or two. It was amazing exponential growth or compression of yields, growth in capital values, and that's what tends to happen, and that is what we are expecting in Romania as well, maybe even this year. This is a very interesting couple of sentences, or the same sentence for Czech Republic and Poland. So if you look at when the biggest yield compression happened in both countries in 2016, it was in parallel with the largest jump in investment volumes. And this is a little bit like the chicken of the egg. You could say that as liquidity increases, and that's probably the first thesis. As liquidity increases, cap rates are coming down. But there's also an element of investors following each other. So as investors are seeing that the yields are compressing, especially if they are compressing gradually. If you remember the slide with the many lines, with the rainbow, you saw Hungary compressing and continue to compress gradually, while other markets went down faster. So if you have that gradual compression, then investors like that development and they want to come in. So it's sort of reflexive, the two reinforce each other. And coming to Romania, we are complaining about high cap rates and low liquidity, but it was also on the basis of lack of product, clearly. Now we are seeing that in the office sector, at least in Romania, we're getting new institutional quality stock. And I think these forecasts, liquidity forecasts in the office sector of 500, 400 million are actually very conservative. We could exceed this easily in 2018 if you know, all the intentions and discussions will materialize. If I may, on an ad hoc basis, add a couple of points which are not on the slide, but very important. If you look, I was talking about inflation and Fed rates and how that will impact cap rates. If you look at the fundraising market, there's a lot of money, a lot of capital coming into real estate globally, in particular into Europe globally. And this money is really not, yes, some of it is earmarked for Western markets, but they are opportunistic. A lot of them go where the opportunity is. So year by year, having more money coming in and allocations by institutional investors increasing for real estate. Actually, in 2017, we had the record dry powder at about 60 billion of euros allocated only for private real estate investment, which was not yet spent. And then add to that the new money that is being raised every year. And every year you have a higher percentage allocation in the portfolio of institutional investors. I think that these borders between CE and SE are really under strain. And I think as early as 2018 will show that we will have a higher liquidity, attractiveness, and growth in investment volumes in Romania, Bulgaria, and some of the other markets.